The utility sector, though, has been outpacing the S&P year to date. And after the rate cut, it could be more attractive than ever. Here to explain why and how to trade it, Mike Khouw is chief strategist at OpenInterest.Pro and a CNBC contributor. Mike, it always makes me nervous to kind of run into something so consensus and loved, but you're saying it's still the time. Why?
Yeah, I think so. I mean, look, I appreciate the concern that somebody might have. I mean, the outperformance of utilities since the beginning of October of last year is pretty extraordinary. I think we've got total return outperformance over that period of time of more than 7.5%. And, you know, if you think about it over the long term, people haven't really thought of utilities as much of a growth sector. But I think a little bit more historical context is in order. First of all, it's trading about 19 times forward earnings. Typically does trade at a discount to the market, but one of the reasons for that is that the explosive growth that we saw in, among other things, electricity demand in the post-war period. So after World War II through, call it 2022 or thereabouts, we saw about a 6.5-fold increase in electricity demand, and then it kind of stagnated from 2007 onwards. But I think we are going to see a second leg, essentially, to electricity demand growth. Two things are really propelling that. I mean, EVs are a part of it, and that's not quite the same as putting air conditioning in, the southern parts of the United States, but it is material. We're going to probably have an electric vehicle fleet that's about 50% by 2030 or thereabouts. And the second thing, of course, is what everybody's talking about right now, which is, data centers for AI. And that is also clearly going to create massive demand. We can see that with some of the transactions that people are talking about to basically meet their generation needs. So I think you combine those two things, and I think it's still reasonable. And it's also important to remember, XLU, the ETF that was tracking, the utilities, this thing was essentially flat before we started to see this recent outperformance. So I think this might still be the beginning of it.
Sure, and you're saying the multiple is, not extended at this point compared to history. I mean, just today the news that Microsoft is going to bring back a 3 Mile Island nuclear reactor is the epitome of this trend that we're talking about. So for people who want to play this space, what's the best way to do so?
Yeah, I mean, obviously XLU is an ETF that one could own, but if you are concerned about chasing it, and I mean, it obviously has had exceptional performance. We're talking about since that October timeframe that I was referencing, it's up more than 40%. Hard to believe we're talking about normally safe and stable utilities here. But the other thing is that because they are usually pretty stable, options premiums are relatively cheap. So if you were looking to make a price action bet that XLU could continue higher, you could go out and buy some longer dated call options and then look into essentially selling some downside puts nearer dated against it. We call that a diagonal risk reversal. But I mean, the simple part would just be to buy longer dated call options because those options premiums are very reasonable.
Diagonal risk reversal sounds like some kind of Twitter account or album that we need to come out with or something. Nevertheless, a couple of different ways to do this, Mike. And thanks for joining us to make the case. Good to see you today.
Thank you.
Mike Khouw on utilities. Over to